Okay, that was my Wi-Fi, so sorry about that. But I'm back, and we are recording. So this is the special virtual meeting of the Economic Development Commission on Thursday, December 17th, 2020 at 6 p.m. And we're calling the meeting to order. I'm going to start with the roll call. So I'm going to go down the list, and just for anybody that would even listen to this recording, which I don't know if it ever happens. We'll announce people as they join, because sometimes that happens. So I'm Dave Hammond, the chair, and I'm here. I'll just go down the list and say here if you're here. Kevin Bowdler.
I'm here.
Jim Lathrop. Suzanne Lane. Not here. Richard Balistraki. Not here. Dan McFadden. I know that Dan won't be able to make it. Bill Hobbs. Not here. Virginia Abercrombie. Not here. Pete Robinson?
Here.
Yep. John Godin.
I'm here.
Chris Donahue. He's not here. And Cullen Hagan.
Here.
Very good. So we have a quorum of 5, and so we're going to get started. The first order before we get going with business, before we get going with Don Poland's presentation, is to approve the prior minutes. That was the meeting of Thursday, November 19th. We had the main attraction, or the main feature of the meeting was Don Poland presenting the Stonington Land Use Regulation review that he had done with regards to affordable housing. So regulatory regulations that pertain to affordable housing in particular, or to make housing more affordable in Stonington, if you will. We then moved to a discussion on the fixed assessment that wind companies had requested from the town for the 82-unit apartment building in downtown Pawcatuck. And the goal there was to have some talking points that were drafted by myself, endorsed by the EDC, and then provided to the Board of Selectwomen for their use. So that engendered, considerable discussion, and which is good. So I had some input. I did some revisions. We did have a vote, and it was not unanimous, but we did have a quorum of folks that said community outreach effort, and they would go on Stonington 1649. They would go in
Dave, we're losing you if you can hear us.
out a editorial calendar and list of topics, and everybody's volunteered for that, and Kevin's running that. So I think that's kind of a rundown of we also covered a CIP item that Susan has put forth in the budget, just to everyone, or the budget request, and that had to do with a revamp of the Stonington zoning regulations. I like to call it a contemporization of the regulations to make it relevant for, what people need and want today. And so we said we would write a letter of support, which would then be read out or submitted to the select women and to the Board of Finance, so that we could get funding for that. I saw in the budget that the request is for $75,000, and it would be money well spent by the town to contemporize those regulations. So we talked about that, and Pete is going to write a letter of support. He's going to draft a letter of support, and if he hasn't already, he's going to talk to Susan to get some insights into what to include. Okay, so that's a brief synopsis of what we did a month ago, and I guess I'd entertain a motion for approval of the minutes.
So moved to propose a motion to approve the minutes of the special meeting of 11/19/2020.
Second.
Second was, who's second?
Two of us did. John did, and I heard one other voice.
All right, I'm going to give it to John because he, that's his first second. You can.
It's a big one, John.
Yeah.
That
You
first
get
second.
promoted. The next one, you have to go for a motion, to make the motion next time, John, and then you'll really cut the grade here. So, all right. So, any corrections, edits, or any discussion about the minutes? All right. Hearing none, the minutes are approved, and they will be submitted and passed to file at Town Hall. So thank you very much. And so now we're going to move right into the feature attraction, which is Don Poland's going to give us an update.
Once I figure out where my buttons are. So let me share screen. Tonight I'm going to do what's hopefully going to be a relatively short presentation, or at least shorter than the prior two, which is on the third technical memorandum being produced as part of this study. And that is on housing incentives. So, going to do a brief introduction and a brief look at the challenge of affordable housing and financial feasibility. And then we're going to look at 6 supply side incentive programs, and I'll explain that further when we get there. So on the introduction, generally you can kind of break this down into 3 categories of incentives. Those that reduce or remove impediments, and that's what we did on the regulatory review of the zoning regulations and the recommendations related to that. Oh, I forgot to say, I just wanted to thank you guys for the very thoughtful and lengthy feedback on the zoning districts and regulations and so forth that you sent on after the meeting. And I'm meeting with Susan and Keith next week to go through those and ultimately discuss incorporation into what is the final document. So the remove impediments is that. Then the next area is incentives to increase demand for housing. And this usually focuses on the demand side. It's usually focused on programs like income vouchers and so forth, and ultimately beyond the capacity or capabilities of a municipality. So usually handled by federal and state, which leaves us within the third category, which is supply side incentives. And these are incentives that are or tools that are strategies and programs aimed at increasing the supply of housing. Specifically, in this case, the supply of affordable housing within the community. So that's essentially the primary thing we're gonna focus on tonight is 6 areas where I think there's opportunities to provide supply side incentives. Very quick, just kind of, I want to talk very quickly about housing as a commodity. We don't often think of it. I'm not sure we often think of it as a commodity, but if we compare it to other commodities, we quickly realize there are differences. So I always do this in kind of starting off with the telephone. Not sure any of us have this style phone anymore. Maybe 1 or 2 of us have a flip phone or something. But even things like payphones have pretty much vanished from the landscape, because things like smartphones have creatively destroyed all the telephones that came before. The same thing is true with automobiles. Yes, there's still collectors. Yes, you still occasionally see one of these rolling down the road or one of those. But the fact is, most of us today own something that probably looks more similar to this. That is, they go away. They don't persist. And it's from that perspective that we then realize that housing is different. It's fixed in location and non-movable. So it's subject to the forces of change around it. Is the neighborhood improving? Is the neighborhood declining? It's durable and long lasting, and it's expensive to build. That's why it remains on the landscape for so long. It's temporal, meaning it's built at a specific moment in time to fulfill the market needs at that moment in time. So I always use the example, I grew up in a 1,000 square foot, 3-bedroom, 1-bathroom, 1-car garage, quarter-acre lot ranch. Nice house. My mom still lives there. Deficient by today's standards. 1 bathroom, deficient. 1-car garage, deficient. 1,000 square feet, deficient. If I then got into other things like the lack of closet space, deficient. So you get the picture. So that temporalness affects it. And then ultimately the phenomenon of creative destruction or the process of innovation, where new methods, materials, techniques, designs, and in the context of housing amenities, ultimately creatively destroy the product that came before. And that was the example with the cars and the telephones. All of this can ultimately lead to functional obsolescence, that there are properties that do over time become functionally obsolete. But when we look at the housing market, we then end up seeing, and none of these houses are from Stonington, just random pictures off of the internet. But the intent here is kind of different periods of housing moving forward in time. It changes just as any other product, no different than those telephone or car images, but all of these things remain on the landscape. The prior ones don't go away. So that makes it unique. So the challenge of affordable housing, ultimately, the largest challenge is getting it built and maintaining it. And that comes down to financial feasibility. So the report that I issued for staff in draft form, which I just sent, I think, yesterday because I forgot about it. I was 99% complete and then got sidetracked. But anyways, I sent it off to them yesterday. There's a section in it that focuses on this challenge of affordable housing and financial feasibility. I used a recent article that I wrote for the Connecticut Planning Magazine about financial feasibility and affordable housing because it fit perfectly with kind of what I needed to convey here. The basic summary of it is that when you have, if we just look down here, when you have an affordable housing development that has a percentage of units fixed at certain incomes, that decreases the rents that are ultimately collected. On the development side, that means it decreases income to the property. So if we look at this table, what it ends up showing us, assuming 100% occupancy, which never happens, but 100 units market rate at the prevailing rent would gross income per unit ultimately totaling $2.4 million in gross income per year. If you then do an 8-30G with 70 market rates and then the split of 80% AMI and 60% AMI for 30 units, you then see the monthly rents decline based on the income fixing, the yearly gross per unit declines, and the total declines. So we end up with 2.2 million. So that's 11% less in total revenues coming into that development than what would come in on the straight market rate. That's ultimately the challenge we're confronted with, that it's not easy to make these things work financially. And we're just doing 80 and 60% AMI. If you push this down to 50% AMI or 40% AMI, these numbers drop. Every 20% of AMI equals approximately like $330 in income. So get down to 60 to 30% AMI and you're down to an affordable rent of probably around $500. So that's the challenge being dealt with on the development side.
Hey, Don, quick question.
Sure.
sort of how fair is it to assume that there's always going to be 100% demand at that market rate price?
That's a good question. I'm not struggling with it. There's never going to be 100% demand. I think at the end of the day, it's, you know, for any development coming before the town, I typically make the assumption that the developer, the applicant, has done their market research and wouldn't be proposing it if there wasn't enough demand to support it. Now, is that 100% true all the time? Probably not, but it's more true than not. So I think in general, developers know what they can do and what they can pull off. So long as you have, you know, ideally any developer wants above 90% occupancy. Anything at around 94% occupancy, you're just talking natural turnover in units. Unit vacates, they have to do renovations to it and then bring it back on. It's just naturally occurring vacancy built into it. So long as occupancy rates are up over 80, 85%, things are good. It's when you get into those lower AMIs, that's where the housing needs assessment, I think, was important to show that you actually had a need at those price points. And as we showed, I mean, ultimately, the greatest need is below 50% AMI. And that's not surprising because the less income people have, the more housing becomes challenging. Did I answer you? If that's specifically what you asked me.
No, I guess I was thinking about it like coupons, right? Like most people are willing to pay market rate for something, and coupons exist to sort of expand demand that would otherwise not be there.
Yep.
And so that's kind of where my brain was going. Like, is it really financial loss, or are you just opening up, you know, a greater level of demand at different price points by virtue of that? That's all. I didn't mean to go into I don't know.
Hey,
yeah, if I could then. I think one of the things to recognize is that market rent, typically in Connecticut, and I'm using kind of an average number here, it may be a slightly higher or slightly lower in Stonington, but this average number, market rent is usually less than 100% AMI. So market rent usually probably runs at about 90% AMI. So that's why I'm always kind of skeptical when we talk about 80% being affordable. It falls really within what are market rents. Studios and 1 bedrooms, it's a market rent. When you get into 2 and 3 bedrooms, it becomes slightly affordable. So the loss is real because it's a loss in revenue. I mean, ultimately, you know, this rent versus that rent is a substantial difference. So,
yeah.
Did someone else start talking?
yeah, Don, I have a question though. My
Sure.
logic when it comes to market rents, and I used to be in commercial real estate for years, is we're always working under a premise that there's a prevailing underlying vacancy in that market at that market rent. So I don't think we're not assuming, correct me if I'm wrong, when you're talking about market rent, you could be assuming a 5 or 6% vacancy in that market for that market rent unit, correct?
Yeah.
Okay.
Yeah.
All right. Then the logic makes sense to me. Thanks for clarifying, Don.
Yep. No problem.
Hey, Don. Don, this is Jim Lathrop. I joined the meeting a little late. And I apologize if I missed some of the context at the beginning of the meeting, but 80% are different percentages in a village like Pawcatuck versus, you know, it is really 80% of Stonington is market rent in Pawcatuck, or is 100 in Pawcatuck. Isn't there a little bit of that going on, you know, from town to town that identified by village like this one?
Yeah, definitely. You know, all of this at the end of the day, you know, these are average numbers to provide an average picture. And they're going to vary, not just across the region, but they're going to vary within the neighborhoods of a community itself. Then, if we went back to just kind of the housing needs assessment, I think in there discussed the differentiation between existing housing stock and rental rates, existing units versus new construction units. And at the end of the day, if we're talking about supply and kind of adding supply to meet the demand for affordable housing, we're typically talking about new construction, which from a policy perspective is challenging because we're talking about the most expensive product that we're trying to produce. So hopefully that helped, Jim.
Yeah, well, it seems like the question politically, locally has been, why is all the affordable housing going in Pawcatuck? And I think the answer is 80% of Stonington's average, 80% of that Stonington average is 100% market rent in Pawcatuck. So if you game it out, it's pretty effective for a developer to put affordable housing there because it approaches market rent yet stays within the guidelines.
Continue. Sorry.
So I mean, I think it's. I don't know if you've seen this in other towns that again identify by village or have definitely different characters to different parts of the towns, but I would hope that in the affordable housing document, we get some of that in there because of how strongly, Stonington identifies by village.
Yep.
And it is attractive for an investor. If you get, the rent that's going to make sense down here, averaging Stonington in Pawcatuck, wouldn't make sense in Stonington Borough or near downtown Mystic, near the river. I mean, it would be a greater hardship given the land cost there.
Yep. And remember, some of that does relate back to it. Just the planner inside of me ends up coming out. Right. Most of Stonington is low density, or at least outside of the villages is low density. So then you have the higher densities that are available in the villages that are going to become more appealing ultimately to the multifamily or higher density market.
One more quick one. Typically, when a municipality embraces new construction affordable housing, and I think the document that Dave wrote, very thoroughly researched about the land bank, really made me think of this. What typically happens to existing stock when, and in this case, I'm thinking Pawcatuck, the affordable housing, there's a lot of old existing inventory. What typically happens to that when you start having new construction affordable housing go in proximity to it?
Yeah, there's what's called a rental shift, and that is, and I wouldn't be as concerned about it in a Pawcatuck or Stonington in general. In a place like a Bridgeport or a Hartford, it's a big concern of mine, and that is if you have very low demand and you start adding large amounts of supply. Studies have basically shown that in that type of market, say a depressed neighborhood in Hartford, it takes about 4 or 5 shifts, and that is basically the new unit comes onto the market. The most savvy renter upgrades into it. There's about 4 shifts that occur behind them, and if no new demand or no actual demand exists, then the weakest unit in that market will go vacant. So by continually adding supply without addressing demand, you can ultimately start driving up vacancies on the weakest properties. I haven't seen any conditions, that say to me things are that weak down in, Pawcatuck, or really, I mean, down anywhere within Stonington, and there's probably only very select maybe neighborhoods, and I'm just thinking off the top of my head, New London and Norwich, that may actually be at risk of that. But it is a phenomenon that occurs and has to be considered. but I don't see it coming into play here. Hearing nothing else, I'll continue. So basically, I kind of worked this down to 6 supply side incentive programs I think you guys should consider. I summarized them here. There's more detail on them in the draft report. And some of them are repetitive because at the end of the day, and I won't spend much time on these, adding density and density bonuses. And essentially, we discussed this in the regulatory review. Density is not just about units per acre, just about, minimum lot sizes. Density is also affected by parking standards and all those other things that constrain the lot and what can be built on it. And the majority of the things we spoke about, so we talked about accessory apartments, duplexes, attached or multifamily, minimum residential unit size standards, and then residential mixed use. We talked about parking requirements and even some of the non-conforming lot issues in those higher density zones. And all of those ultimately get at density. And then there was also a recommendation for increasing the amount of density available for the attached or multifamily housing. And there was a recommendation out of that report related to the number of stories. So ultimately, we've already started addressing this kind of density or the idea of density bonuses. So the primary recommendation at this point on this strategy is follow the recommendations on the previous report. Other things that could be considered if you wanted to go further, create a more specific density kind of bonus. That is, you could consider an affordable housing overlay zone that would be applicable in zones that have public water, public sewer, have an affordability requirement in it. Typically, what I see communities doing out there is 20% of the units as affordable at 80% AMI, and consider maybe even going a little higher in density than what was recommended previously without the specific zone. So while I said 6 to 8, maybe 10 to 12. That's one way. The other way would be just add an affordable housing provision, 20% of units, 80% AMI, to your neighborhood development district, and once again strive for a similar density there. So that's one area. The second incentive side is, once again, the efficient planning and permitting. We talked about this on the last one. What I'm just going to focus in on here is the recommendation. I mean, at the end of the day, and this isn't you guys, I'm not being critical or blaming Stonington. This could be any community I'm sitting in front of, or the overwhelming majority of communities I sit in front of. That is, you're over-reliant on special permits. I think we started having that discussion a bit last time. And if you could move more housing into the as-of-right site plan category, that'd go a long way for developers, having that moment of scratching their heads and going, do I really want to fight the public hearing battle in Stonington once again? So that should be considered. These next two really kind of start getting into how can you reduce some of the costs related to the development, which gets at ultimately then the financial feasibility. Permitting fee reductions and waivers, I think, are a great strategy. Also, I have this constant frustration with fees, especially working on the developer side. Your guys' fees are actually reasonable. There's nothing that unreasonable with your fees. Some communities can get out of control. I was dealing with a application in New Rochelle, New York, a few years ago, and all the fees, when you put the permitting in, you put the sewer connections and all that, we had 200 units and we had $6.7 million in permitting fees to the municipality. Now, that's New Rochelle, New York, different market, it could handle it, but fees can get outrageous. The interesting thing is, while they generate revenue for the municipality, and you guys do get income from fees, and they offset your taxes and so forth, the fact is, only, I believe, your net revenues, when I looked at your budget, only 1.4% of your Stonington budget actually comes from licensings, permits, and other fees. So they're negligible in the context of total revenues. But I looked at one of the developments that I worked on your town, and we had just shy of $2,500 per unit in fees related to the permitting process. So that number can be substantial on the soft costs for the development of housing or commercial development. We talk about hard and soft costs. Hard costs, labor, construction materials, all those things that kind of don't fluctuate much. They are what they are. The soft costs is then the permitting. It's the attorney fees, the accountant, the consultant, and so forth and so on. $2,500 per unit in fees is 6 to 7% of soft costs typically, and it's about 2% of total development costs per unit. So we start seeing that those fees do have an impact on the cost of development. So allowing a reduction in fees or allowing a waiver of fees, either on a development that the total development that's providing affordable units, or just on the housing component if it were mixed use, or even if you just did the waivers or the reductions on the affordable units, structuring some form of waiver or reduction will help ultimately with the front end costs of doing the development. The flip side from the front end then becomes the back end costs of once you build it, you then have the costs of operating it. And that's where tax abatements typically come in. It's kind of funny, if you went back about 15 years ago in Connecticut, it was almost unheard of to do a tax abatement on a residential property. Tax abatements were economic development and commercial oriented. And really over the past decade, since kind of coming out of the recession in 2009 or whatever, we've seen a constant uptick in tax abatements on multifamily residential. I've been involved in about 7 now, both working for developers and working for municipalities on trying to structure these things. And the fact is they can have a significant impact on whether or not the development gets built. And for many towns, that becomes kind of the driving force, kind of this development won't happen unless, the town plays a role in it with the abatement. I think it is something that should be considered. And ultimately, that's kind of funny. I dropped some information out of here when I was summarizing things. Ultimately, they can have a significant impact on the operations side of the development. In general, when I'm kind of doing fiscal impacts, I'm typically looking for taxes per unit on a multifamily development. The property tax portion usually runs somewhere between $3,000 and $4,000. Occasional high tax community will push higher. Occasionally see it drop down to about $2,800. Typically shooting for somewhere around $3,500 per unit in tax value. Once again, if you divide $3,500 per year in taxes by 12 or $3,600 by 12, you start seeing that, the property taxes become a meaningful portion of the rent itself per unit. So by granting a tax abatement, you can ultimately reduce the fiscal burden on the operation side. Down here, I put in the tax increment financing because we have new legislation as of 2015, I think, that allows for tax increment financing. This is where you use the difference between current value, proposed future value of the development, that is the increment, and you take that future tax value and you dedicate it towards securing bonds on the front end. Some developments need cash on the front end to help make it work. Some need it on the back end. The back end is the tax abatement. The front end is ultimately the TIF. For places like a Pawcatuck or whatever, a TIF district could be beneficial on both the residential and the commercial developments side of the equation. And once again, could be utilized to help with affordable housing development.
Hey, Don,
Yes.
how prevalent is TIF financing right now? Are you seeing a lot of it going on in towns our size?
Yeah, we're seeing a lot of communities adopt the TIF districts. I think there's kind of a mixed bag. I think CCM just did a program on it. I wasn't able to see it on kind of where a few years into this, how is it going? Our general feeling of what we've encountered as the biggest challenge is going through a bonding process is expensive. You know, you lose about 10% of the project value to the cost of bonding. And therefore, unless you have a $15 million plus project, you're not going to go out to TIF on a $3 million, 6-unit rehab just to say in Pawcatuck. So it's kind of a mixed bag depending on what it is. The large mills that get rehabbed, the TIF works really well. So,
but the TIFs are being guaranteed by the town, correct? Not the project.
Well, there's two ways you can go with the bonding. So, and I'm always awful in my bond terminology. But there's two types of bonds. One is secured and protected by the town, where you're putting your weight of the town. And the other, the interest rate's a bit higher. It's not secured by the town. It's secured by the project itself. So you can go the TIF route without sticking out the neck of the municipality.
Okay, thank you.
Yep. So then the land bank, which you guys asked me to look into, and I know you've had some of your own looks. I think Dave did a white paper and so forth. Land banks are interesting. That typically I don't see them popping up in wealthier, stronger market communities like Stonington. They're the things of the Hartfords, the Bridgeports, the Detroits, the Youngtowns, and so forth, where they're really dealing with blight. And it's the, foreclosure on tax liens on properties. And then what do you do with all this foreclosed property that the municipality now owns? That being said, they can be a meaningful tool as part of a larger strategy for, say, the redevelopment of a place like Pawcatuck. And then in the context of affordable housing, they provide you the ability to, provide the land at low or no cost and so forth. So there is some potential value out there. My gut tells me, though, unless you have a large amount of vacant underutilized land, not your farmland, meaning, brownfields or whatever, or unless you have a large number of blighted and abandoned properties, physical buildings, the structuring of a land bank probably isn't going to be worth your time and effort to actually pull it off. I wouldn't take it off the table instantly, but my thought is it needs a further look, and it's possible you guys have done that or are doing that. The last one, I saved the best for last. Number 6 is the most interesting one to me, which I truly think has the greatest opportunity for you guys to be proactive about housing and specifically about affordable housing. And that is the creation of a housing trust fund or an affordable housing trust fund. Connecticut general statutes allow municipalities to create sinking funds that can extend across budget years. So they can exist in perpetuity. They don't have to, be depleted and replenished on a yearly basis and so forth. And that's this section of statute. You could create a housing trust fund and ultimately raise revenue for it. I'll get back to that in a moment. And then use it to target ultimately affordable housing. And in this case, I kind of think, since we did find the greatest need is at 50% AMI or lower, and that's the most costly and most challenging affordable housing to get built, I think if you were to do a trust fund, then that's the target market you'd want to aim at for that. And this is the whole thing. One, it could be a line item in the budget that say every year the town puts in $10,000 or $50,000 or $100,000 in the trust fund. Number two is you can also capture, let's say, off of your single family residential developments that aren't producing any affordable housing units, you could capture the permitting fees, the zoning and building fees from those, and say any money generated off of single family residential housing through permits is going into the trust fund. So you can capture other revenues to help fund it, however you so choose to do that. And also under the IRS code, the fact is a municipality can accept a donation so long as it is for public purposes. The donor can claim it as a charitable contribution, write it off just like you were giving to the Easter seals or whatever. So you could also fundraise on such a fund. And when we're talking about a wealthier community like Stonington, that may actually be a viable option. So I provide in the report a sample from the town of Fairfield. They have established one. So I provide a sample ordinance. I'm not recommending that you just take their ordinance and use it. I think you could write a better ordinance that's more thoughtful, aimed at how to best structure this thing and raise funds. But I think the Housing Trust Fund is a very viable option and much better than something like the Land Bank. You then have to designate an entity that would oversee the trust fund. I think you guys as EDC are probably the best entity to oversee such of it. And you can then provide grants to developments that come in, to help with the affordable housing component. And you can do other things. This is just the short summary. So those are the 6 main incentives that I think the town, that you guys should consider ultimately as part of this housing and affordable housing plan and strategy.
Okay, thank you very much, Don. Those are all, I think, compelling. And you will send this out to us?
Yep, I'm going to send it right now. I'll go back into your email and get it out to you.
Yep, thank you. So we'll go around the room for comments, and I'll start to give folks a chance to gather their thoughts. So I think the trust fund is compelling and interesting, and especially since we looked at the land bank and that doesn't seem like a fit for Stonington. The trust fund could be, and so Don, I'll send you a copy of it because I haven't so far, but we have the affordable housing proposal by wind companies. Some of it's at 30% AMI, so it really is trying to satisfy a lot of needs as far as demand goes, and they did request a tax abatement. So I'm going to send you some information with regards to that project. I may have sent you some before, I can't remember. With regards to that project and with regards to the tax abatement for consideration. So I think, what you included in this rundown was really helpful with regards to what costs or what the, kind of the revenues foregone are for affordable housing, and then how you make up that difference. So to connect that dot between how revenues decline because you're charging less rents, but you still have fixed costs to cover. I think that's a really important point to be made so that people can understand why a company like wind companies would be requesting tax abatement. So that all kind of brings it full circle. I thought that was really helpful. Don, I don't know if you caught it, but in one of my emails, I think it was you were on it, but I cited some. It's chapter 9 in our plan of conservation and development. And so I don't know if you've done this in your drafts of the plan, but it would go in a number of these slides also, is cross-referencing certain points in our POCD. So for example, in 9.1.7 is an incentive housing zone, and 9.1.9 is a fee in lieu of payment, which fit within two of the incentives that you listed. And I think just cross-referencing our own POCD, whether it's in this presentation or not, but certainly in the plan, can really help with support of the plan, because if we can, advocate for the plan that you draft with other commissions like the Planning and Zoning Commission, whose responsibility it is to try to get a fee in lieu of payment in place, or to look at incentive housing zones and change the zoning regulation for that. We'll be able to say, we're helping you guys out, PZC, by including this in affordable housing plan. This will help you accomplish a task that's in the POCD. So, have at it. And I think that'll be good support to show that. That's all.
In some ways, these three reports I have been kind of writing in a vacuum intentionally. I've looked at that material. I know what's there in the POCD and then other documents. I will pull it all together ultimately in the final plan narrative and document. But I've been trying to stay in this place of what do I think can actually work best in Stonington without being blurred by everything else kind of going on. So that all will come together ultimately January and February when we start getting into a draft plan, and I'll start pulling in all those other policies.
Okay, excellent, beautiful. Thank you for that clarification. And then, sorry for the lecture. So I'm going to go down the list now. Kevin, you're up next.
Thanks. Hi, Don. Don, maybe this follows on to the conversation we were just having, but I think there were, before, when we knew we wanted to do a housing study, we were given 2 or 3 different towns' housing studies. And 2 of those 3 towns' housing studies actually had quite specific recommendations. So they said things like, our goals over the next 3 years are to increase affordable housing by 70 units. And they said, and here are the specific locations in town where we would recommend housing, affordable housing to occur because it's on the sewer, it's close to transportation. Everything you've done so far has been a very high level strategic view of here are the things which you can change, whether it's policies to help incentivize people to come in and build affordable housing. But are we going to get to a stage where we say, listen, here's a set of goals which we as a town want to achieve over the next 5 years?
Yes.
Okay, thanks. So that's fine. I know. Yeah. Okay, so now I've got a couple more specific questions on the trust fund. And we had this big development about 2 years ago. It was on the river. It was probably a $30 to $50 million development of very high-end homes, hotels, commercial space, and it didn't make sense for it to be affordable. But one of the things which it would have made sense to say, listen, if that got approved, then should some, whether it's a dollar amount or percentage amount of that development, be put into an affordable housing thing? And have you seen in towns where that would be part of the criteria, that if someone built something where it just didn't make sense for it to be affordable, therefore, but it's a big amount,
Right.
there'd be some component that goes to affordable housing.
Yeah, so in the draft report, I use the phrase fee in lieu of on kind of non-affordable developments, that there be some ability to pay a fee in lieu of. How that's structured, I'm still trying to work that through my mind and figure out how to do it, because you do run the risk at some number it may work, and then you go over some dollar amount and you totally squash any market rate development. So it needs additional thought, and it will probably need additional thought beyond the recommendations of this plan. But I think that is something that needs to be considered, that other developments pay into the affordable housing fund. So,
okay. The other idea I really liked was the property tax abatement, and I'm assuming that it's, at the moment we only have a one-off process which requires a town meeting. But I'm assuming you're saying we would have something that's clearly written out to say, if you develop a affordable housing which meets this criteria, then we, the town, will give you an abatement for 7 years at this particular percentage rate of whatever the taxes.
Yeah. So most communities, a lot of times communities don't think of a tax abatement policy until they're confronted with someone that wants a tax abatement. And then under 8-3, after based on state statute 12-65, you can just kind of enter into an agreement. We typically recommend to communities develop a policy that provides you guidance moving forward, so that there's a sign of consistency and it doesn't look like you're playing favorites, that you give yourself a framework to function within. And I tried to just give you a little bit of that framework, of this idea of, if it's a development with affordable housing units, you're probably going to have to look at least 7 years, maybe even 10 years, depending on how many units and so forth. So I'd like you guys to keep that in mind. I see so many communities that are just like, oh, they want an abatement, we're only going to do 3 years, we're only going to do 4 years. You just have to keep in mind that a lot of times, more is needed. And at the end of the day, the way these things are always structured is you don't lose any existing tax revenue. What's ever being paid right now on the parcel or building continues to be paid. It's the new income moving forward that ultimately gets abated. So yes, you lose that grand list growth in the short term, 5 to 10 years. But you're not losing any actual taxes that you're giving back. So,
yeah, and I think that the tax abatement idea is it's great politically. I think it is going to be a great incentive, and I think that and the trust fund actually maybe two things which would demonstrate that Stonington is actively interested in attracting affordable housing and development.
Yeah, and I think for the trust fund, I actually used that language in the report where I said, if you want to clearly demonstrate that you're doing something proactive, the trust fund is probably the best thing for you to do that. Not to say that the abatement doesn't also, but the trust fund would really show you're serious about this and you want to do it. So,
okay, that's all my questions. Thank you.
Thanks.
Thanks, Kevin. Jim, you're up next.
I saw Jim dropped off.
Oh, Jim dropped off. Oh my goodness. Being in the heating business and given the snowstorm, I'm not surprised. We'll move down to Virginia. So just for the, sorry, Virginia, just for a second here, just for the record, on the recording, Jim Lathrop and Virginia Abernathy, members of the EDC, joined probably around 6:15. Okay, Virginia, any questions or comments for Don or in general? Virginia's muted. I'm gonna.
Hey, Dave.
Yeah,
I have to jump. This is John. Do you want me to give my quick comments? I have
yeah,
very
John,
quick comments.
yeah, John, why don't you go next?
Okay. My inclination and preference on these recommendations are they're all very, very good. Some I've never heard before. I always jump to my inclination is property tax abatements to drive the returns for the developer, as long as it meets the needs of what the community is. That's my number one priority. That would be my number one inclination, followed by a reasonable permitting process. I mean, you have to go through the permitting process to do any kind of construction in the town, but it has to be reasonable from a time sensitivity standpoint, and the fees should be reasonable. They should not be outrageous for a developer. I've seen ridiculous fees in my former town, and I was kind of surprised by them. I think the trust fund is very intriguing, provided the town has a story as to why we're using it as a tool to promote this type of housing. TIFs are intriguing, provided that the TIF is done specifically under the credit authority of the project, not the town. It really will depend on how big the investment would be. I'd hate to put the town on the hook for a project itself. That's my comments. Dave, I'm sorry for interrupting you, but I was typing it in the chat function before I left.
Yeah, thank you, John. Those are great comments. And Don, did you have anything to respond to?
Just that I'd say 9 out of 10 times towns, when going the TIF route, go on the second, not the first. They typically don't stick their necks out on it. It's rare occasions that they do.
It would have to be a special circumstance because I'd be scared to death.
Yeah.
Listen, everyone, have a great holiday, guys. I have to jump. I'm sorry. Dave, you always have to deal with my scheduling. Thanks a lot.
Thank you, John.
Take care, guys. Bye-bye.
Next on the list is Pete.
Hey, how you doing? Hold on one second. I'll put myself on video. Can you see me? I'm not sure. Oh,
Yep.
yeah, right.
Yeah, there you are.
Anyway, interesting stuff. I have to just, at the risk of sounding, kind of like an idiot, I guess, which is not the first time. You put it in context of I know we have a housing shortage. I know affordable housing is a good thing to do, but just in the why kind of are we doing? Is it like we're doing the affordable thing because it's the right thing to do, or are we required to have a certain percentage of if we're going to do some more housing, or how does this kind of play into the context of why we're telling a story about this?
I think there's multiple whys. One is need. I think you guys as a community, or at least portions of your community, recognize, that there's an affordability issue, that there's a supply issue, and that you need to better provide this housing. There's also the statutory side of it. There is the 8-30G land use statutes that say if you have less than 10% of your housing as qualified affordable, then you are subject to 8-30G, which means a developer can circumvent your zoning essentially and push a development on you that you don't necessarily want. So there's a reason there to get out of it. Number two is, the legislation that brought you this grant funding to do this study is part of a bigger package of legislation that's going to continue to move through the legislature this year, that's most likely going to put more downward pressure on you guys to do something about affordable housing, with some of it going to extremes that could be threatening to take away levels of local control. So I think there's multiple whys here. I could go on and on and on with others, but there's multiple whys here as to why you're doing this.
Would there ever be a case where we're up against a developer, or like two developers? Developer A says, I'm going to do this thing, and it's not going to have any affordable housing, and the other one say, I'm going to have some of it. Is it ever going to be a case where there's going to be something no matter what? I'm just trying to, because you have to.
At this point, I mean, there's no one making anyone build affordable housing at this point. But tomorrow a developer could show up and say, I want to do 400 units at, 20 units per acre, and there's sewer in this location of town, and yada, yada, yada. And under 8-30G can force that upon you.
Okay.
So.
All right. That was it. I just wanted to understand the bigger picture for a second, though. Thank you.
Sure.
Thanks, Pete. Colin.
You're muted, Colin.
The infamous double mute. If this is going to be coming out sort of your final recommendations, I don't think we need to really belabor time here, but I am curious about, of some of those potential tactics you referenced, if there's any sort of perfect, if there's any mixology behind it in terms of recommendations. Obviously, we're going down this tax abatement route now, which has some potential for political sensitivities around it. Other things like, trust fund, it sounds really nice. I could see where on the developer side, they might have questions too, but any thoughts in terms of which levers are, more preferable than others, or is it really more of a case-by-case basis?
It's more of a case-by-case basis. But that being said, I think the more levers you have, the better off you are. Like I said, on the development side, we do a lot of work for developers, and, sometimes they need assistance on the front end. They can't raise enough, financing on the project. And that's where a TIF comes in really well, because bonds can be issued on the front end to bring cash in. Other times, the developers, they're concerned about the margins on the back end, that, their investors want a 12% return and they're only getting 9% when they run their numbers. And therefore a tax abatement can, make up that difference to get it there. So, for me, from an economic development perspective, I've been preaching for years about, swift, certain permitting processes and getting those, barriers or disincentives out of the process to kind of free things up. So my general feeling is, the more levers you can do, the better. Every community is going to have to kind of determine what they're comfortable with in terms of levers, and then in what way they want to use them. And there are other things that have to be worked out here. There is a contradiction. So I say the trust fund, and you can capture permitting fees. I also say, you should consider reducing or abating permitting fees. Those may actually conflict with each other in some circumstances. It's figuring out how to best make it all work. So,
do you find that is it sort of that, a town will decide, what settings to put those levers at, and then they have that kind of configuration, or is it more a case by case with different developers or different situations they come up, they might choose to mix sort of what they use? Because I could just see where, if we're able to establish standards that are clearly identified, then have the potential to get less into sort of politics of, for this developer, you did this deal, this, and we just said, this is our way of doing business. Obviously, you do some flexibility with that, but curious for you to speak about sort of, is it more setting, or, are you using those things a little bit more dynamically?
Yeah, I think the historical inclination of municipal government has been to write very detailed standards on the front end to kind of protect us from the worst case scenario and make sure that everyone knows that, there's no favorites here. And I don't think that has worked out very well. I think it has to be more dynamic. So my answer is, at the end of the day, we see more and more communities shifting to kind of more dynamic policies to try and create that flexibility. Because no development's the same. You know, two developers coming before you, you know, just land costs alone could be different. You know, land costs alone will be different. You know, environmental remediation will be different. The cost of every development as it approaches you are going to be unique. And I talk about that in the section of the report that focuses on the cost of affordable housing. And just that, you know, every single one's unique. And there's, you know, I talk about market rate rents and dollars per square foot. You know, we use on average on a rent for a rental unit for a multifamily, we're looking in general, the starting point to $2 a square foot. For some of our developers, they can make the numbers work at a return of $1.85. At others, we've seen it push as high as $2.75 a square foot. And that's based on the uniqueness of the project. So dynamic is better, and more municipalities are understanding that today and heading in that direction. So.
I think that's all I got. Thank you.
All right, thanks, Colin. Good input. All right, so at this point, I think, Don, I think we're set, and I know you had another commitment. What are our next steps? You know, our next meeting is on January 12th, I think it is, and did you want agenda time on that, or like, what are we looking at?
Yeah, I think at this point, I'm meeting with Susan and Keith early next week. We have a few things to discuss. I'd like to sort some things out with them. January 12th is just too soon for me right now.
Okay.
I don't think that's going to work for anything meaningful. So let us figure out a plan forward that doesn't include January 12th.
Yeah. Yeah, that's fine. Understood. And anything else we can help with in the interim?
Off the top of my head, no, but maybe after I speak with Susan and Keith on, I think it's Monday, we'll let you know. Okay.
Yeah, good. We'll, you know, we'll wait to hear if there's anything we can help with. I think, you know, what we've seen is a lot of engagement from certainly. So wait a minute, time out. Virginia, I tried calling on you. I'm not sure if it's a situation of being on a cell phone and not being able to unmute, in which case I'm not sure what you have to do. It's like *3 or something. I'm not sure if somebody knows,
Yeah,
but
Dave, you're actually able to unmute her, I believe.
no, I can send her. What it says is I can send her a request.
You have to hit *6 to unmute once you send that thing.
*6. So Virginia, if you're still there and want to hit *6, if you had any other comments, that'd be. I didn't want to leave you out. I'm sorry about that. So I know on a cell phone it's probably not as easy. Not hearing from Virginia, I'm going to go back to where I was, which was thanking Don for all the work that's been done to date, and that I think I was mentioning that you've seen an engaged group here, Don. So I think we're ready to step forward if you need any help at all.
Cool. Bless you, Colin, on the sneeze, and thank you guys. I look forward to seeing you soon.
All right. Very good. Have a great holiday.
You too. Bye-bye.
All right, folks. I'm already over time because I said 7:15 adjournment, so maybe I can make it here. The next agenda item is pretty much self-explanatory. That is, there's a couple of members, Colin included, and John, who dropped off that haven't been with us before when we've done this, but what we've done kind of roughly annually is take a look at, and Colin will know that we have 11 initiatives that are kind of in progress now, or on hold, but 11 named initiatives that we're actively pursuing. So what we will do in January is refresh that list And so what I sent to everyone today was the Department of Planning SIP or Capital Improvement Project budget requests. That's input or or ideas for projects that we could assist on if there's something there we can do. And we have our active list now, some of which are largely complete, so could drop off, and some of which are kind of like just barely getting started that we might want to reemphasize. And then there could be any other ideas as we look around Stonington and we look at what the needs are for the community. What might we like to do to contribute within our remit? So what I'm going to do is send out a specific request to please submit to me project ideas or initiative ideas, and I'll compile that list and get it in a framework for us to work with in the January meeting. So that was really that agenda item, and that's all I had to say about that. And everybody looks happy with that. So I guess at this point it's 7:15, so I'll entertain a motion to adjourn.
Motion to adjourn.
Okay. I'm going to go ahead and second.
Cool.
Everybody good? And happy holiday to everyone. Thanks to all the EDC for all your contributions this year. And we'll have the holiday party at some point when we can get together in person. I'm Bob.
Thanks, Dave. Thanks, everybody.
Thanks, Dave. Thanks, everybody.
All right.
Happy
Take care.
New Year. Bye.